Hi, everyone. This is Mathis Khan with Khan Management Group, and this is the Best Stocks to Buy podcast. Today is Thursday, June 21st, 2018, and we're going to look at the second best growth stock to buy this month. On to our next slide. It's called the Setup the Approach. The key objective of this podcast is to present to you a high probability upside potential stock. We use a financial model, a proprietary tool we developed that uses multiple valuation approaches and applies them to over 6,000 stocks every week. So the view that you're getting is not driven by some headline in a popular publication, but simply based on the investment opportunity we can find. Now, an easy way of thinking of our approach is to think about the method of triangulation that law enforcement uses to locate a cell phone. In our case, we use a form of triangulation to locate a future stock price using different valuation methods. Now, the view of creating such a model was daunting, but I believe I was well prepared for the challenge. I have both computer programming experience as an engineer and over $15 billion finance experience. So my approach didn't come overnight. I painstakingly reviewed over 40 years of white papers, taking away the best each had to offer, and then added some of my own tested intuition to implement new data sets that weren't even available as little as 10 years ago. Furthermore, my model uses both historical and projected values and takes into account management's historical accuracy of meeting the projections that they share with the public. A point worth remembering is that these views are based on today. Unforeseen economic report, a regional conflict, or a revised policy can change these expectations tomorrow. Benefit of using a professional money manager like Khan Management Group is having someone experienced in making educated assessments about the uncontrollable, as well as someone to readily share their opinion about whether a particular event is reason for concern. So, the best growth stock to buy, the second best growth stock to buy this month, is in the recreation industry. Here's an industry overview. The recreation industry is comprised of globally operated companies involving the sale of recreational products and services. Here are 10 large competitors, just to level set to kind of give you the right frame of mind. Pool Corporation, AMC Entertainment, American Outdoor Brands, Brunswick Corporation, Carnival Corporation, Cinemark Holdings, Callaway Golf, Cedar Fair Limited Partnership, Hasbro, Harley Davidson Incorporated. Now, some of the growth drivers in this industry is related to a very healthy economy. So a very healthy economy is highly correlated with the recreation industry. Similarly, a positive housing market is also highly correlated with the recreation industry. Additionally, low unemployment levels, as we have right now, also leads to high levels of discretionary income. Some of the industry challenges, global economic threats right now related to China and Russia, and also the industry is very sensitive to economic downturns. So the name of the company this month that we believe is the second best growth stock to buy is called Thor Industries. The ticker symbol is THO, and we see this company's 6-month upside potential at greater than 40%. On to the quick facts slides. Here's a business summary description. Thor Industries manufactures a wide range of motorhomes and travel trailers in the United States and Canada through its Airstream, General Coach, Dutchman Manufacturing, Four Winds, Thor Industries West, and Thor Industries of Pennsylvania subsidiaries. It is the largest manufacturer of recreational vehicles. So when you see all these RV trailers or RV vehicles themselves, that, Thor has the largest market share. Another popular company in the space is called Winnebago, which, people remember quite readily. The website for Thor Industries is www.thorindustries.com. Their headquarters is in Elkhart, Indiana. They were founded in 1980, and they have 17,800 employees. On to the metrics slide. Over the last 12 months, the revenue for Thor Industries was $8.2 billion. The net income over the last 12 months was $439 million, and the cash from operations was $424 million. So this is a sizable company. The operating margins in 2017 were at 9.1%, and 2018 they dipped ever so slightly to 8.6%. Onto the valuation metrics. The trailing PE ratio for Thor right now stands at 11, and the forward PE ratio stands for 9, is at 9. And that means that earnings are expected to increase, and that's the relationship you like to see between trailing and forward PE ratios. The PEG ratio is at 0.7. Usually anything at 1 and below is considered a bargain. The price-to-sales ratio is at 0.7. The price-to-book ratio is at 3.2. And the enterprise value to EBITDA ratio stands at 7.2. Thor does pay a dividend right now. The dividend yield is at 1.6%. And over the last 3 years, the average dividend payout ratio, the percent of earnings paid out as a dividend, is now at 24%. Onto the price chart. Thor has been a little volatile over the year. About a year ago, the stock price was around $104. It was high as around $160 back at the beginning of the year, and is now back down to $104. So the reason for the pullback was that there was a general RV industry concern back in January that inventories were just too high, and it caused a sell-off in a number of RV related companies, of which Thor was one of them. But we believe that concern is what's leading to the attractive buying opportunity of Thor right now. On to the next slide. It's called Looking Back and Looking Forward. As I was getting at, looking back, the sales and earnings for Thor have recently reached record levels. They've been steadily increasing for several years now. So another reason why we believe the pullback was unwarranted. The growth is from their both towable and motorized RV sales. Go look at their website. They have a very large portfolio of vehicles, meeting a variety of tastes. And similarly, the towable RV backlog, the number of vehicles they have on order but not yet sold, is up significantly. Looking forward, the sales and earnings are projected to increase over the next year. So that's a good thing. Due to the company's strong balance sheet, Thor Industries is expected to continue to reduce its long-term debt. And strong sales growth is leading to speculations that the firm will increase its production capacity. The why now, the bull rationale. Why are we bullish on Thor Industries? The increasing sales and revenues per share outlook, which is very positive. Right now, the valuation metrics are low, and they're expected to be even lower on a forward PE basis. And the change in the capital structure. The company is expected to significantly reduce its debt, which, of course, means more cash stays within the company or it can be distributed to shareholders. On to the summary slide. The financial statement quality of Thor Industries is excellent. The operating margin trend we consider to be flat. The price pattern trend is negative, but as we mentioned, we just think that's been an industry overreaction. The industry outlook is positive. The economy still looks good. Low unemployment looks good as well. Similarly, for overall market outlook, looks positive. The recent closing price for Thor is $104.36, and we see a 6-month price target of $148.80, and this means a 6-month upside potential of greater than 40%. So it's for all these reasons that we believe that Thor Industries is the best growth stock to buy right now. I hope you found this presentation helpful, and we'll talk to you again soon. Take care.